What generation bought the most homes last year? Welcome to Real Estate Daily with the House Heroes. I'm Ryan Leneker, stepping in for Troy Reed. Thank you for joining us. If you like our content, please make sure you hit like below and subscribe with those notifications on so you get notified when we do go live. Today is Wednesday. I think it's probably April 26th or something like that. It's been a rough day. I haven't had to write any contracts yet today, so I haven't even looked at the date. But let's jump right into it. So millennials, you know, they said they were going to be the empty generation, the lost generation, all kinds of different stuff. I can't tell you how many reports I saw that said that millennials were not going to be buying homes. They weren't going to be homeowners. They were going to be, quintessential renters for life, right? And that is all being proved wrong. It looks like they might have just been slower starters, right? So all my millennial friends out there, you're a slow starter. How about that? So anyway, so millennials bought more homes than any other generation last year. What's interesting is Gen Z, they are starting out of the gate much faster than millennials were. So I don't know if it has something to do with millennials, right? They watch their parents go through the foreclosure years, right? 2007, 8, 9. They had the 2000s, right? You had the dot-com bubble go down. So they had seen quite a bit of crazy stuff going on where, the Gen Z rolls in, the world's happy, we're in good times. And on top of it with social media, I feel that there's a lot more content out there right now on the importance of being a homeowner, on all of the equity you can build, and on a lot of financial actual learning and teaching and stuff like that. So I think Gen Z has had some benefits that the millennials didn't, and it's showing right now. So 30% of 25-year-olds owned a home in 2022. So that's Gen Z, which is normally 1997 and on, right? Where millennials are roughly 1980, 1981 through 96. Sometimes they'll, depending on report, they're kind of into the early 2000s. But so a 25-year-old right now is Gen Z. 30% of all Gen Zs at least owned a home in 2022. And if you go back in time and look at 25-year-olds when they were millennials, only 28% of them owned a home. 27% of my generation, Gen X, actually owned a home at 25. And boomers, 32% owned a home at age 25. So really, they're all pretty much in a tight grouping there, plus or minus 5%, right? From the high to the low there. What else was interesting is what percentage of populations in those generations own homes now. So 71% of Gen X owns their own home. 79% of baby boomers own their own home. And that's the thing, majority of the homes coming on the market right now, they're being given up by those boomers who are moving in with family, moving out of state, and moving into nursing homes or passing away. And they are the largest home owning population. And that's really right now, with everybody locked into these low rates, that's the only ones we really see selling in mass. So right now, as it sits, 26% of adult Gen Zers own their home, and 52% of millennials own their home. So they were slow out of the gate, but they're definitely not too far behind where they should be at this point when you really look at Gen X. So I thought that was an interesting report on numbers, just because I know in the past, again, we heard over and over that they just aren't going to buy, and that is absolutely false. And that is also what's adding a ton of this demand in the market, even though affordability has taken a huge hit, right? We had a big run up in prices, then we had a big run up in rates. So we've got the double whammy, but because of low inventory, prices, after last year's slight drop, they've been pretty steady. So we're actually seeing I got this out of order here. Case-Shiller report came in and said that real estate nationwide had a 2% gain in pricing year over year from February to February. So what we saw here in our local market and most of the US is we saw like a blow off top kind of in that mid to late April. May has stalled out, and then June, all those rates just went through the roof. So May, June, we saw prices start to fall. May was when things started sitting on the market a little bit longer. So it's going to be very interesting to see as March numbers come out and April numbers start to report what that looks like on a year-on-year basis. I was actually not overly surprised. I thought we were going to be flat February to February. I think that we'll probably be flat March and April to April, roughly 0% gain over those months. And then after that, I think we might actually see some positive gain for some of those other months year on year. Again, National Association of Realtors is expecting gains over the next 4 years. So 2024, 5, 6, and 7, they're expecting between a 3 and 5% gain in housing prices, which just leads you back into that question: do you rent or do you buy? Right? It's an age-old question. And my biggest thing is if you can afford the home and if you have a long-term outlook, if you're staying here longer than 3 to 5 years, you should be probably buying a home. So if you can afford the home and you're approved for the home, I normally say pull that trigger, because it's not about timing the market, it's about time in the market. And that is the most important thing. Get in when you can and just enjoy that roof over your head. This article is pretty interesting. It kind of goes through, and there's a lot of decent articles out here that cover this. I know we've done some videos in the past, but it's just talking again with surging rates on top of previous, high prices. Affordability is a little rough. And as such, it's normally cheaper to rent than buy. But what I always have to remind people is you can't just look at rent. Rent is that component that you flush down the toilet. And a mortgage, your payment is made up of 4 things, right? You have PITI, principal, interest, taxes, and insurance. That principal you're paying down, that's like a forced savings. So whatever that component is, that's the money you're borrowing from the bank and you're paying it back. So that is equity you're building. It's like having a forced savings account. It's like when you put money into your 401k out of your paycheck. You don't say, oh, I actually only made this lower amount this month. No, you made that entire amount, but you were smart and put money into your 401k, and maybe there was employer matching and stuff like that, right? This is the same thing. Of that monthly payment, a certain portion is actually going to pay down that principal. So your equity is going to build. You're going to, over long periods of time, have capital appreciation, and you're going to build equity by paying down that loan. The beauty is the further out you get, especially in a high inflation environment such as we're in now, the present value of that money is worth more than the future value of that money. It's going to be very easy to pay back, $500,000 in 30 years. I mean, that might be your annual pay in 30 years if you're at 75,000, 50 to 75,000 a year now, right? So because, of inflation, right? So you always want to borrow now, pay it back over a long period of time. And that's how you're going to help see some of that appreciation as well. So anyways, that mortgage component, you also have to talk to your CPA and see the interest. I normally equate that to the part of rent. Rent 100% gets flushed down the toilet. I say, hey, you know what, that interest component, let's call that being flushed down the toilet, but really it's not, because you might be able to itemize your taxes and have some additional write-off. So that's something you absolutely want to talk to your CPA about. When I normally show a $2,500 rent payment to a $4,000 mortgage payment, all in for my clients, it normally ends up being very close to the same payment. So you need to do some of those numbers for yourself. If you have any questions on it, please DM us. Also, feel free to click the link below and you can get our buyer's guide emailed to you, where we cover everything you need to know if you're going to get in the market to buy a home. And if you have any questions on that, please DM us as well on that, or comment below. We'd love to answer any questions. So from there, it kind of just talks on, but don't buy a house based on the price, it's based on the payment. Yeah. And buying a home is part of the American dream. It really is. People who have homes on average are more happy, right? You have the freedom. You can add, you can expand, right? You can paint, you can do all kinds of cool weekend warrior projects that add value to your home and really, customize it to the way you want. So there's multiple reasons that home ownership is important. And that's why I believed in it at a young age. Actually right out of college, I was buying my first investment, and then I bought my house right after that. But it's because I absolutely believed in it, and I now see the benefit of time in the market, both on my primary residence and on my rentals. So get in when you can. It's solid. Don't try. So many people are out there trying to time the market. So and then on top of that, a lot of these people trying to time the market, you don't know what's really coming down the turnpike here. So one of the themes we're starting to see play out with this banking, let's call it crisis, there's a lot of government involvement trying to keep it from getting out of control here. But one thing we are seeing is banks are slowing down their lending. So especially if the bank had a high commercial real estate exposure, commercial real estate, a lot of economists are talking they might actually be overpriced somewhere between 30 to 40% on value, especially in some of the urban market centers. Some of those are going to be working on converting to homes over time. It's going to be very interesting to see this play out. But what is important to note is commercial real estate on most loans, they're adjustable loans. So you either have only a 5-year fixed term and then it's adjustable, or you might only have a 5-year loan and then there's a balloon payment. You have to refinance the whole thing. A lot of loans are coming due in this market where their value is already down because they have low tenant, commercial tenants, right? Office-based tenants paying rent. So the value is lower because the income is lower, and the value of the asset is based on the income it derives. So because that's lower, there's a hit to the value, and it's making it hard for them to refinance because they're actually underwater on a lot of these loans. So a lot of these banks are worried. So a lot of them have slowed down lending, cut off lending. We're also seeing it in the automotive market. So a lot of banks, Ally, Capital One, CACC, a lot of those banks are starting to pull back funding for what they call floor plan loans. That's for used car dealers to go buy, cars on lines of credit. A lot of them are pulling back credit lines there. So we're seeing in the commercial real estate space, constricting of access to loans and loan money. And we're seeing it in auto. I know that consumer credit card debt is on a quick rise. So a lot of banks are starting to get worried about that and try and rope in some of that. And we're now seeing the federal government get involved with consumer lending for residential real estate, right? We saw the most recent passing of loan level pricing adjustments. So if you've got a low credit score, you actually are getting better pricing and better terms than if you have a high credit score on government-backed loans, right? It's been all the uproar last week. So you have to remember that sometimes when let's say prices do come down in the future, or all of a sudden rates do come down in the future, it doesn't mean that you're actually going to be able to get a loan on that property. I remember trying to buy loans or buy property in 2009, and I couldn't even get hard money on some of the properties I wanted to buy because credit and access to capital was so hard to get. So keep that in mind when you're looking at your decision to rent or buy. That's why timing the market can be so tough, because once you find that home that you want, the price you want it at, you might not be able to get it. Or if you find that home and the rate's looking pretty, you might not be able to get it. So again, if you're out there and you're approved for a mortgage, they normally only are going to approve you up to 45% of your, pay minus all of your other debts. I feel that's a very good level. And if you got to suck it up for a year or two and not travel as much and refinance as fast as possible after that, I think that's a good little sacrifice to make for your long-term capital well-being. So here's our outlook. Yesterday, April 25th, Optimal Blue mortgage indices, they had the 30-year conforming mortgage at 6.39. Obviously, with everything going on, you really want to talk to your real estate agent and a couple of lenders in your market, because real estate brokers, loan brokers right now can take you a couple different spots other than the traditional government loans, and it might be better pricing for you and better terms depending on your credit, so that you're not paying the federal government excise tax, let's call it. So thank you for joining us. Again, please click below. Don't forget to download our buyer's guide. Don't forget to hit the like on this video. We really appreciate it, and we'll see you soon.